All right, so I want to talk a little bit about cycles and how the cycle may change as a result of this new buyer that's coming in to Bitcoin. One of the things that I think people are really mistaking, especially people that have been in Bitcoin for a while and studying old Bitcoin education, is people are really not taking into account what a $200 million a day buyer can do to a market. This is not your average market like real estate where suddenly you've got a new buyer coming into a $300 trillion market. This is a market that reached a maximum peak in the last run of 1.1 trillion. And now you've got $200 million coming in every single day like clockwork from this new buyer that is unrelenting, unforgiving, and is determined to allocate to Bitcoin at any expense, and also determined to never let go of their Bitcoin at any expense. So this is a shift in market dynamics, so therefore you can reasonably assume that there will be a shift in cycle dynamics, right? And I think what we're going to do is transition from this 4-year cycle. So just to give you a little bit of background, and as I've been saying this, like if you look at my video from yesterday, I told you that over the first 26 trading sessions of these ETFs, they've been buying 3,859 Bitcoin per trading session, which is terrifying, right? If you really think about it, and that's why I've been saying and asking you if you will now subscribe to the channel to keep up with that information, because 3,859 Bitcoin a day, the cycle of old, let's say, right? So the pre-ETF cycle for Bitcoin was as follows, right? You would have the halving, the price would bubble around, the price would accelerate to post 6 months of the halving, and then into the following year you would have your blow off top, and then the market would run into a 2.5-year bear market. That makes sense for an asset that was more retail driven. Retail loses its confidence. It's now got to gain back its confidence. It now comes, figures it out, gets apprehensive like a little cat moving towards the target. And then suddenly it pounces and then the excitement's over, right? That's more of a retail driven perspective on a cycle of an asset with this much volatility. Institutions are not going to be thinking like that, at least I don't think. I think what the institutions are going to be doing is buying up to a certain amount of their assets under management. And until they do that, they're not going to stop buying. And then when they have passive flows coming in, they're going to have to allocate them. And every single day, they'll be allocating them. So I think we turn from this, cyclical 4-year cycle, which is what Bitcoin has been going through, to more of what I like to call the perpetual cycle, right? The perpetual cycle is basically a fancy way of saying this idea that really I think the booms are going to soften out. I think the crashes are going to soften out. And I think that you're going to see more of this cyclical wave-like pattern in the markets rather than this run up and then crash and then sideways for 2.5 years and then run up. And I think all of that emotion, as an asset grows up, just think about a child, right? As a child grows up, when a child is young, there's more emotional volatility, and then when that child grows up, it grows up more, there is less emotional volatility, and markets are very much similar, right? So as the child is young, which is Bitcoin has been young, it was more volatile. As it gets older, you're going to start seeing less volatility. Now, what does that mean? I think that what that means is you're going to see more of this on the way up. I don't think it's going to be a straight line up. I think there will be some selling due to rebalancing, people saying, okay, I've made enough money, I want to get out. And as that pivots, the nature of the buyer will pivot. And the nature of the buyer will pivot to someone who already has so much money where they're not looking to get in to try and make money. They're looking to get in because they need to preserve wealth, right? And that's really the buyer shift that will happen over the next 5 years, I believe, in Bitcoin, is that you're going to see a lot of retail. Once it gets past 100,000, if you've been holding since $2,000 a coin, you're going to look at that and go, okay, maybe I should offload a few coins just to enjoy my life a little bit, et cetera, et cetera. But unfortunately, the person that you are selling that coin to is already enjoying their life. They don't need Bitcoin to do anything in order to enjoy their life. they're already living the vacations, they're already living driving the car, they're already living in the house, they're already living wherever they want to live. Life is good, their children are grown up, and all they're looking to do is preserve wealth and stay in the game a little bit. So that's the shift that I think is going to happen here. And I think a lot of people are mistaking that. And ultimately what that does is it slows down this 4-year pattern, and it sort of evens it out into a perpetual cycle, which is just ongoing. But you have, run-ups and then little pullbacks and then run-ups and then little pullbacks and then run-ups and little pullbacks. And how I will know that this is what it's turning into is if during the next bear market, the inflows keep coming in, right? So even if there's retail dumping $500 million a day, does the 200 million stay there, right? Does the 200 million net stay there on a daily basis? So that's what I'll be looking for to see whether I'm right and see whether this cycle is shifting this time around or the next time around. It's going to shift. It's just a matter of whether it's shifting now or whether it's going to shift in 4 years once the asset has gained more maturity. So the question is Bitcoin mature enough to shift shift cycles, or is it going to shift into the future? Now, what does this do for diminishing returns? I don't think it affects diminishing returns. I think it might affect diminishing returns on a 4-year cycle window, but I don't think it affects diminishing returns in any way. Like, I think that the diminishing returns idea where, every 4 years the return of Bitcoin is slightly less, I think that's about to go away because you've now entered an adoption curve that is much more like, it's a shock, it's an adrenaline shock to the system, which is what the ETFs are, right? You've basically injected adrenaline into a system that was already running around like a bull in a china shop. So this is going to get crazy. However, I think overall it's going to smooth out because of the maturity of the asset and the maturity of the buyer. It's really about the maturity of the buyer, not really the maturity of the asset. The maturity of the buyer is going to force that stable, everyday 200 million coming in every single day, no matter what you do. It doesn't matter whether Bitcoin's up. It doesn't matter whether Bitcoin's down. I'm buying 200 million every single day. That is really what is going to cause this cycle to change and cycle to mature. And this is all positive because what this allows you to do is bring in more demand for income products, because income products require a little bit more stability in the market. It allows older people to get in and base their retirement portfolios off the asset, etc., etc. This may take a little bit longer than what I'm thinking in this cycle, because this cycle may be one of the ones that just people start running away with it. But I think what you're seeing here is Bitcoin go through its Tesla moment, right? Bitcoin, where Tesla basically, every Russell 2000 asset manager just decided, we need Tesla, get Tesla now. And it will have that run up and then it will sort of stable out. So that's what I think is going to happen here overall. But I think we're entering a phase of Bitcoin which I would like to call the perpetual cycle, which basically means that it's really just a soft cycle that goes on forever. It's the same thing that gold went through when the ETF came out, right? Gold had basically eight up years following the ETF launch, and it took about a year to get started, which sort of lines up with what this is. And that, the reason why it takes a little bit of while to get started is because people have got to educate people. People have got to, train people. People have got to sell the asset to their clients. Like, all of this is going to take time. Plus, you've got retail that can't even be sold the asset yet because of whatever due diligence BS that's going on inside of the advisory firms that will kick in, within 30 to 90 days after an SEC product is launched. So there's a lot coming in here and focusing in on this summer period, which is quite weird because in the summer you normally have the saying, sell in May and go away. But this year could sell in May, go away. I don't know. That could be interesting because you're about to see a lot of demand come online. And then not only that, once it goes into the prospectus of, okay, these are the funds that we have and how's it performed in the last quarter, and by the way, it's the number one performing fund, that starts driving demand as well. So I think you're about to see this consistent $200 million a day stay there. I think the cycle is going to, instead of going up and then coming down and then staying flat and then going up, I think all that's going to shift to this sort of grab your surfboard, basically, right? Rather than your bungee, grab your surfboard, basically. So overall, I think the cycle starts to change now. I don't know whether it completely shifts in this halving cycle, but I think by the next one, the cycle is going to have pivoted to this more mature asset class. And I think diminishing returns is going to break over the long term, and we'll have to evaluate how we evaluate diminishing returns in a cycle that's maybe two cycles within one cycle, right? Because that's what would happen if you flattened out the returns. You would have maybe two run-ups, and then instead of just one run-up every 4 years. I do definitely think that the year that the halving happens, or the year following the halving, will be like another adrenaline shot, where suddenly, like, if the cycle's been doing this, it will suddenly go vroom, and then it will start doing this again. So I think there is that 4-year adrenaline shot that will be given into Bitcoin simply because of the supply tightening. But besides that, I think we're looking at more of a soft approach to markets. I don't think there's going to be 90% drops in this, that, and the other, depending on what this buyer does. So we'll find out. But ultimately, despite all of that, you need to figure out getting to your one Bitcoin or a certain percentage of your portfolio, because if you're not doing it, someone else is doing it. And Bitcoin is a finite asset, which means if you don't get it and someone else gets it, you can never get it ever again. Why? Because there are always only 3 rules to Bitcoin. Step number 1, you buy Bitcoin. Step number 2, shut the fuck up. And step number 3, you get fabulously wealthy.